I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you.
Hi everyone, I'm Jason Balara and this is the Know Your Why podcast. Today I'm here with Lane Kawaoka. Lane he currently owns over 8,000 rental units and is leader of the Hui Deal Pipeline Club. He's acquired over $1 billion in real estate, and he used to be an engineer. I think left that field about 2 years ago. But first of all, Lane, thank you so much for coming on the podcast. I really appreciate it.
Hey, thanks for having me. Aloha, everybody.
Yeah, and I would love it if you would kind of just give us a little bit of your background, tell us your story. Interesting that came from an engineering background and now are massively syndicating tons of real estate. So yeah, maybe just tell us a bit about yourself.
Yeah, I mean, I kind of grew up in a family that we're taught to go to school, study hard, be frugal with our money. This is kind of what I call that linear path that a lot of us just kind of fell into, right? I went to schools, was pretty decent at math and science, so I guess I became a freaking engineer, right? So
Makes sense.
went to work and as a construction supervisor, and made a pretty decent salary and saved a big chunk of it, and was able to buy a home in Seattle, Washington back in 2009. And because I was traveling all over for work, I never really had a headquarters, and because I was single at the time, I just decided to rent it out, kind of like Turo style. They never had Turo back then, but that was kind of the start of it all. It's like, whoa, I'm just like making all this extra money, and the tenant's paying down my mortgage and getting these tax benefits, and that was kind of start of it all, to this simple passive cash flow.
And so so you weren't living in Seattle. Were you traveling there a lot for work? You just kind of picked Seattle. How did you come upon that market?
Yeah, I mean, I went to school at University of Washington, went there from Hawaii and started working up there. And, I was working for the railroad at the time, where, you travel all around Montana, Texas, Oklahoma, and it was 100% traveling job. And I was only home on the weekends, maybe Saturday if I was lucky. And, I had this big house to myself. And at one time it was like a big goal of mine, right? To buy the house to live in.
Sure.
Because everybody says that's like the escalator to building wealth. And then I kind of realized it was kind of dumb, right? To have this big house to myself, and it just seemed a little inefficient, like, yeah. So that was kind of the start of it all. I just called up an old property manager and said, like, hey man, can you rent this for me? And we were off and rolling.
Awesome. Yeah, I kind of like that point that, the picture of, I don't know, success, wealth, whatever you want to call it, that gets painted is, you got to buy yourself a house. That's the key, right? Like that's the starting point for anybody that wants to build their life. But in reality, it's really not always the best decision, especially if you're going to buy something that's maybe outside of what you can afford, which I think a lot of people do that. They sort of stretch when it comes to buying their personal house. So how did that, you came upon that realization, and what did that, how did that change your outlook? How did that change your mindset from there?
Yeah, I mean, I kind of quickly realized, you're making money four ways with tax benefits, mortgage paid down, what tenant is, putting in their heart, sweat, and tears, paying that for you, the cash flow, and then the appreciation. I was like, whoa, this is pretty powerful stuff. And if I just kept my head down, kept saving, and bought a handful of more of these, I would be definitely on the way out of the rat race, which I didn't like my job. I mean, what engineer really does like their job? You don't interact with people. You don't really help people directly. So there's not really much enrichment or engagement on the job side. So just kind of from 2009 when I bought the first one, bought another few rent units more. And then around 2012, Seattle, Washington, it's like a primary market like California, New York. The numbers aren't going to work there, period. You're not going to find rent to value ratio properties 1% or higher. So at that point, I pivoted to going remote and bought a whole bunch of properties in Birmingham, Atlanta, Indianapolis, got up to 11 rentals in 2015. Still, 11 rentals for people who own those turnkeys. It's a few $100s of passive cash flow each. Great stuff, but nowhere near to like replacing my income at my day job. But the net worth was growing, right? And I think that's what a lot of people don't realize is, just this passive cash flow game. It takes a while. From 2009 to 2015, and then I kind of pivoted more towards syndications and private placements from then on out as I became an accredited investor myself.
Yeah, I think that a lot of people do think, oh, I got to start with the single family things, and you had, like a lot of people have that sort of realization almost on accident. You buy that first house that you're going to live in, and for whatever reason, you end up renting it out, whether it's house hacking or you move and you don't want to sell it, whatever the case may be. And so you're like, oh, this is effective. But you're right. You might make a few $100s per month per single family property, but it's not the type of thing that you can really scale well, or you're not going to replace your job, like you said, especially if you're making good money.
Right.
So
right.
When you pivoted to syndication, how did that start out for you? How did you get started in syndication?
Well, I mean, I kind of fought it a little bit, right? Because when you do one thing and it's all right, and you've kind of done it 11 times, you start to think, hey, I'm just going to keep doing this. And then, like around 2015, I definitely started to feel the headaches of a landlord. For some people, some insights, so they don't have to do the same kind of nonsense I did. And if you have 10, 11 rental properties, you're going to have an eviction or two every year, and then some kind of big catastrophe that happens every quarter. You have a professional property manager dealing with the day-to-day on the front lines for you, but you're still approving work orders. And boy, without the cash flow during those periods, it's sustaining maybe a $20,000 repair when somebody jacks up your property. You quickly realize that it's just not scalable. So, that was kind of where I started to join different masterminds, get around other high net worth accredited investors. And a lot of them, they had no skin in the game, right? They aren't here to sell me anything. They're just peers and colleagues. And a lot of them were saying, yeah, you still own these rental properties, they're a pain in the ass. Now we just are passive LP partners in large syndicated deals where somebody else is putting in the hard sweat and tears and value adding. And to me, it sounded amazing, right? And the tax benefits are a lot stronger via cost segregation, bonus appreciation.
Sure. So did you start investing in syndications as an LP? Is that kind of how you got yourself in the game?
Yeah, I mean, to me, like that was kind of the first way to get in, because no one's just gonna let you invest as a general partner. What the heck do you know, right? You're just more of a headache than anything.
Yeah.
Like people ask, like, "Hey, man, can we GP with you?" I'm like, no, like just it doesn't work like that, right? If you don't bring the deal, you don't bring in the capital, and you don't have the experience already. And whether the experience is legitimate experience where you're actually doing stuff, or just on paper via balance sheet or Fannie Mae, Freddie Mac experience or FHA experience, like, no, you're dead weight. Nobody wants you. So, how do you first get going in something? Well, you pay the ticket, get on the ride, right? Get in that passive investor seat. And that's a great way to just get started too, right? Then you empathize because you were a passive investor. You know what kind of thoughts and questions that passive investor is reading. You see some really bad monthly reports. You see some good monthly reports, and when you kind of try and create your own, you empathize what works and what doesn't.
Yeah, no, those are great points. I think that seeing what you like out of other operators as a passive investor really helps you when you then want to go into, sort of being being more on the active side, and then you're sending out those reports, or you're doing those distributions, or however, whatever the case may be, you can learn from others, and pick up on the good habits, and hopefully not the bad ones. So then did you transition sort of then into more of a active role at that point?
Yeah, I mean, at that point, a lot of people kind of were following myself and kind of just wanted to jump into deals with me. So the Guido pipeline kind of came together, and we just started to do deals, picked up a lot of, crappy Class C properties, 40 unit, 52 unit, 70 unit, these small, very small deals that were kind of a pain in the butt to manage. But hey, that's all you can get when,
right,
there's a new kid on the block, and, the brokers don't really take you seriously. And then you've got to kind of take for what you can get. But yeah, that's how we kind of started, right? And, just kind of clenching our butts to raise the capital to complete the deal so we don't lose our earnest money, and then jump into the deal. Then you kind of just battle things as they come. Luckily with real estate, it's not like a venture capital where reliance on the operator is kind of the 99% of it. If you buy the right property, these deals definitely do run themselves.
Yeah, that's I feel like that's a little bit of a contrarian take. A lot of people put a lot of, I think, emphasis on the operator, and I think certainly the operator matters a lot. But yeah, when it comes to real estate, most of the time, if you've bought it right, you're gonna go ahead and sort of things are gonna go decently well. You may make something decent if you're into great if you're a great operator, or you might make something a little less than great if you're not a good operator. But it's true. I mean, that with venture capital, it's a little bit more of a gamble, but real estate has it's a very tangible, safe asset to invest in.
Right. I mean, there's always two sides to a coin, right? The marketers are always going to say, yeah, you got to just bet on the jockey. And by the way, we're a great jockey, so
Right.
you can invest with us.
Yeah.
But, sophisticated investors, they know how to run the numbers, P&Ls, rent rolls, run it through their own analyzer, see what number they're getting at the bottom of the page. Trouble is, most passive investors don't have a clue how to do that. I mean, you're not even given P&Ls and rent rolls as a passive investor. So you can't even begin to do the due diligence on your own. So I guess I see where the advice is coming from, right? But it, quite frankly, is y'all passive investors don't know what you're doing, so you might as well just bet on the jockey.
Yeah, no, it's valid. I mean, if you don't know how to underwrite, you don't know how to really decide if a deal is good or not on your own, then for sure you need to be investing with someone that you trust does know those things. So, I mean, you don't just get to 8,000 units and billion dollars assets under management doing 40, 50, 70 unit deals. How did that grow and scale for you? What did you kind of what steps did you take?
Yeah, I mean, we just kept on doing more and more deals. I think we realized that there was a certain sweet spot when you get above 150 units, because everybody talks about having that leasing agent in the office at all times, so you have a physical presence, blah 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 blah. But where things really start to get cooking, and where you really get to get economies of scales, when you are able to first hire that handyman that kind of is that person's right arm person, because the leasing agent is just playing on their phone all day long and putting out some marketing here and there, and interacting with prospective tenants. But it's that person that they lay out the work orders towards, whether that be plumbing repair here that you don't have to pay third-party repairs, or we'll get like HVAC certified folks, so they can at least take care of like those easy repairs, for HVAC repair and stuff like that. That's really where you get the economies of scale, like above 150 units and above. But yeah, I mean, just kept doing deals after deals after deal after deal. I think we've done over 50 deals thus far. So, take that divided by 50. I don't know, is it like 100 or 200 units kind of average? So yeah, there's a few like larger complexes in there, like a 303 unit, 426 in there, but you know, a lot of it was just kind of grinding away at 100 to 200 unit properties on average in there. But the larger properties to me are the more robust ones. I mean, when I just look at, you know, income kind of is relatively consistent, kind of creeps up over time, especially as you increase rents. But the expenses are the ones that jump up and down because you might have prepaids here or there, and then obviously the income minus expenses, then the operating income that should steadily rise over time. But it just seems like with the larger properties, and maybe this is kind of obvious, but you know, when you have the larger properties, you just seem to stack up cash a lot quicker. You know, like the larger properties, you know, you'll be stacking up 50, 60, 70 grand every month, where with a little 50 unit, I mean, you're grinding 5 grand profits on a month-to-month basis. It's hard to get enough substantial money in the bank to be able to pay out distributions of those. Even though percentage rise, it might be the same, but just a little bit more consistent, the bigger stuff.
Yeah, I mean, if the rents are the same and you're collecting on a 50 unit or a 400 unit, it's just the numbers that you're getting each month. It's just a much higher total value, and if you can have the efficiencies of scale in those large properties, that's where you're, you know, really going to make that difference even larger, because if you can decrease your expenses, that the rent number is just a lot higher, the income number is a lot higher.
Right. And when it's time, you know, the quarterly times to make out distributions, I mean, we don't have a really good system to it, right? It's kind of like, you know, how much money you're going to spend on your vacation every quarter or every once a year, right? You look at your bank and you've got 60 grand there, your personal expenses are $10,000 plus or minus every month, and you want to line up 3 months of cash reserves. You know, there's no science to this, right? I mean, and the more money in the bank, the more confident you are to distributing out more, and you know, distributing out less, although it's better in the safety of the investment for sure, it does make investors upset. You know, they would rather see the distributions come back to them. But this isn't a REIT, right? REITs are, you know, 90% of distributions come back to the investors, which sounds amazing for investors, but in all truth and honesty, it may not be aligned with what's best for the asset in its longevity.
Yeah. Well, in a REIT, there's no tax benefits. There's no sale where you're going to get to participate in the sale proceeds and things like that. So I've had people ask me that question. Well, like, what's the difference between this and a REIT? Like, a REIT is basically the stock market. It's the same as investing in Apple or Amazon, whatever it is, with dividends. And in real estate, you're actually, you know, it's actual ownership. So I think it's a lot better. But I actually would love to dive in a little bit there on your philosophies on distributions, because I do think that's one of those things that sort of everybody does a little bit differently. And there is no hard and fast rule about, you know, are you going to do it monthly, quarterly? How much is it going to be? You said you don't really have, you know, a system to it, but what goes into your thought process when you're doing that?
Well, I mean, the asset better be doing well, right? I mean, that's number one. I mean, we've got kind of 3 goals in a lot of these projects. First, capital preservation. People don't lose money. So that means, you know, fortifying the cash reserves, working capital budgets, so you're not caught with your pants down in case a pandemic or a little recession happens. The second goal in that perspective order is, you know, completing the business plan. If you look at a lot of deals today, especially with bridge notes, I mean, only like 1/3 of the money or less is coming through the cash flow in the first 5 years, 6 years. In most, 2/3 of the money, vast majority, is coming in that value add. So, and that means putting the money into the asset, bumping the rents up and creating money that way. And so thirdly, the last, and which doesn't always get hit, which is cash flow. And investors may not like to hear about it, but they, to me, if you're hitting on those first two objectives, that's all an investor could want. I mean, if you get cash flow, to me, that's amazing and great. But most passive investors who are accredited and have been pretty seasoned, they don't give a rip really what happens on a month-to-month basis or even a quarterly basis, right? Like these little cash flow checks that you get, it's nice to get them, but it's not changing anybody's life. It's certainly not changing an investor who's $1 to $2 million net worth and greater. Now, if you're a newer investor, yeah, I get it, right? We were all there at one point in time, but I'm just not going to run my deal like a Ponzi scheme where I raise $500,000 extra to pay out the pref. Like that's just not right. And it's right, I guess, if you disclose it in your PPM, people can do whatever they want if they disclose it. But to me, that's in a way, it's like taking out extra leverage, paying out investors money just to keep them happy. And then what happens if there's some kind of hiccup in the economy, right? You don't have those cash reserves because you paid it out.
Right.
You get asked for it back.
Yeah, right. Yeah, if you distribute all the capital and then have an issue, now you're doing a capital call and asking for the money back. So I mean it's
people do it all the time, right? And a lot of times passive investors don't have a clue it's happening. Just fatten up your CapEx budget and just raise extra capital there. It's done all the time.
Yeah. I
mean, the banks don't let us distribute out the first couple of quarters until certain metrics are hit. That's just, so I don't know how money is leaving, magic, I guess.
Yeah. Yeah. And I get it really has to do with one, your communication with the investors and being just transparent and saying, hey, in a lot of ways, especially these, moderate to heavy value add type deals, it's a lot more like a flip than it is, sort of a stabilized cash flowing asset. You've got to put all that money into your CapEx and take time and get those rents up. And then in the end, you're going to sell it for much more, because with cap rates, it's a multiple of whatever your NOI is. And so you're 100% right. Like that's really where you're going to make money. It's not, if you invest $100,000 and there's an 8 pref, like that's $8,000 in a year. Like nobody's retiring on that. So it's kind of, unless you have a huge amount of money invested into these deals, then that cash flow component of it, it's probably not going to change a whole lot. But what's going to change your life is that, if your money gets doubled every 5 years, right? Like that's ultimately what I think what people are really wanting. And I think that's kind of the point you're getting at.
Yeah, but I get it, right? Like if you haven't seen the dance, you haven't seen your money come back full cycle to extra capital in whatever years, then especially if you have a skeptic spouse, right? Like they're giving the person a hard time. Like what happens with our money? We get it, it's measly $2,000 a year or every quarter. I get it where the pressure is coming from, but it's kind of like one of those things that you just gotta sit and wait. This isn't 2016 anymore. Back then, 80% of the deals were done with Fannie Mae, Freddie Mac, non-recourse, fixed debt, and you were able to cash flow at 8, 9, 10% plus per quarter. That ain't happening anymore, right? Like the returns are still there, but it's flipped from 80-20 to 20% of the deals are long-term Fannie Mae, Freddie Mac, and the majority of deals are done via bridge note. And the bridge notes are good in in the right deals. They can be very dangerous in the bad deals, but it's kind of what the tool is for, is to go on and value add the asset, refinance it without a prepayment penalty, and then return a lot of capital.
Yeah. Will you define that for people, just bridge debt, just for anyone listening that doesn't know exactly, kind of the distinction that you're making here? I think that'd be a good thing to sort of put out there.
Yeah. It's like a tool, right? You use the right tool for the job. in terms of real estate investing, right, you've got a couple of general options, right? You've got the long-term fixed debt where it might range from 5, 8, I think we've gotten even as long as 12 years, right? Which sounds really cool, right? Like you don't have to worry about interest rate changes, but the downside of that is you have heavy prepayment penalties, like 1 or 2% that you may have to cough up if you refinance or exit that asset earlier. Which, if you are doing everything well and that's a good market, you should be exiting earlier, but you're going to get hit by that 1 or 2% prepayment penalty. And sometimes we're not going to get into the details, but you can get these step downs. It's not as extreme as what I'm saying, right? But the other option would be like more of a bridge note. There's a huge range of these bridge notes by a huge range of different lenders and banks out there. But as the name suggests, this is made to bridge you to when you value add the asset, whether that's 6 months or 3 years, or if you're super slow, 10 years, whatever, right? Like, the average bridge notes are 2 to 3 years, and then if you get caught, you can usually extend it a couple times for a couple of years. But the nice thing about the bridge note, well, the bad thing is obviously the rate resets. But if you're doing value add real estate, who cares? Interest rate doesn't matter. Interest rate matters if you're buying like turnkey rentals and you're doing the buy, hope, and pray model, right? Then your interest rate has a huge implication on your profitability. But if you're in the value add game, you're creating so much value that you don't give a rip what the interest rate is for the most part, right? Within reason, right? 7, 8%. Now that might change the numbers a little bit, but the interest rates can go up pretty high from where you're at today for that to really start to impact things, because you're making so much money in the value add creation on a month-to-month basis. I think I was just showing somebody at lunch here today, if you're just changing out 5 units, out of 100 or 200 unit complex a month, which isn't much. Sometimes you can get done 10 units in the heavy months, but you take 5 units and you increase the rents by $150, times that by 12, and then divide that by a cap rate of 0.5. I mean, you're creating like almost $200,000 of value every single month. You don't care about your little interest payment going up a quarter point or half a point or even a full point on an annual basis at that point.
Yeah, 100%. I mean, that's it. That whole point you just made about, I think a lot of people that maybe don't understand, new investors, things like that, and they say, okay, so if you turn 10 units, like you said, you go up $150 per unit per month. They're like, oh, well, that's only $1,500. Like, that's not, they're like, that's not this crazy amount. But what you're not realizing is then you multiply it by 12, and then you divide it by the cap rate. And so the actual value of the asset has gone up tremendously. It's not that small amount of money that you're just getting in extra rents. So that's why, anyone listening, that's why Lane's saying, like, when you're using this bridge debt and a lot of these value add deals, the real payout comes at your capital event, whether it's a refinance or a sale, because you've increased the value so much based on whatever that current cap rate is. And so it's an important thing that I think people don't necessarily know. And so, yeah, that the interest rate on the bridge debt isn't that important because of all the reasons you explained. You might be a point or two higher than you would be on that, agency long-term debt, but you won't have the 1 or 2% prepayment penalty on the back end. So it's kind of, it makes it up.
Yeah, I mean, I don't want to be cavalier in terms of interest rate doesn't matter, because just some people just can't get it through their dense skulls, right? Like some people, like they're like, oh, what's the loan to value on it? And they just won't touch it if it's like higher than 75%. But I'm like, dude, that has like, don't look at the debts, don't look at the loan to value. That's like basic investing rule of thumbs. Look at the debt service coverage ratio.
Yeah.
That's what the banks do. That's what the pros do. the banks don't look at the cost, loan the value. They look at debt service coverage ratio. Can this thing pay for the debt service? And I think that's a lot more sophisticated way of looking at this. I mean, it's just like, it's essentially like that age-old question that you see in the newbie forums, where like, what's the most I should leverage my property? It's like, well, take it up to 1.25 debt service coverage ratio, and that's what you get, right? That's your loan to value. That if you want to play it safe, you know, you want to be more aggressive, go to 1.1, 1.0, but that's at least you're talking in terms of like a numbers based thing where variables can change. You still hit, you know what your numbers are, but the loan to value thing is just kind of one of the superfluous things that people latch on to. Just like, you know, thinking, oh, bridge debt's always bad, or, you know, like, you know, interest rates always super important.
Yeah, no, it's true. I mean, the thing that I have learned and sort of realized is the structure of your debt, and not necessarily, yes, interest rate is a part of that, but the whole structure of your debt. Like, do you have interest only payments? How long are those for? What's the prepay? All of that wrapped up together might be the single most important thing about your returns. Maybe
I agree. I mean, like the interest only thing, like I agree. That's a great, you know, you can get like 4 years of interest only, but some investors, they're freaked out about that. They're like, oh my God, you're not paying any interest,
right.
or you're not paying any
paying
off the
principal.
principal.
Right? Yeah.
And but they kind of like, look, what, you know, whatever investors with the clients, they're always right, I guess. You know, whatever.
Well, it just depends on what your strategy is, right? If this is like maybe something that you're buying yourself or with a small group of people as a joint venture, and you're going to hold it long term, and this is an asset you're going to pass to your kids. Yeah, you want the lowest interest rate for the longest term that you can get. That's
because you're doing the buy, hope, and pray model.
Right. Right. Yeah, you're looking for that sort of long-term thing. But if you're doing, you know, what most people are doing in the value add space, and it's a, you know, we say, you know, 3 to 5 year turnaround, but a lot of people are getting this stuff done in 12, 18 months, less than 2 years. A lot of time it's just, it's going fast. So it at that point, to maximize the returns, you essentially have to be paying the least amount that you can in mortgage during that time, so you can put it all into the capex and increasing the value of that property. So it's just not to belabor the point, it's just like a incredibly important component of it that I think most people that haven't been doing this for a little while don't understand how critical it is to how the deal functions.
Yeah, I mean, essentially, it's kind of like a slow flip. I mean, if we're rehabbing 5 units, bumping it up $150 a unit, I mean, that's creating 180 grand of value. It's kind of like if, you know, we did a house flip, like, you know, buy a house that's 400,000, put a bunch of work into it, 100 grand of work into it. Now it's worth 700.
Yeah.
But you're doing that every single month without all the BS. And if the economy kind of crashes, at least you hold on and cash flow, as opposed to that flip, you're screwed, totally screwed.
Yeah, no, it's totally true. It's just doing that on a larger scale, right? And with the ability to create more value more quickly, because it's not entirely based on what the market is doing. It's based on the value of that property, the rents received and stuff. The cap rate is kind of a measure of the value of the market value, but you know, there's a lot more that goes into it. One of the things I wanted to touch on, because it was, you mentioned it kind of in your bio and everything like that, was infinite banking. Is that something that you're sort of utilizing, you're a big fan of? What's that, you know, what's your take on that?
Yeah, I mean, I've been doing it since I think 2016. I did like a little policy for myself where I threw in like 50 grand every year. There's some pros, mostly pros, some cons, right? The cons are, you know, you're paying some fees to the agent on the front end, which, you know, you should break even point on that, you know, a few years into the future. So it all should be gravy after that. But the pros are when you load your money into this, it's sort of like a tax loophole, right? If you stay below your MEC limit, you should be able to, you know, not pay taxes on the gains, which is, the loser in this is the government, right? Because it's kind of, that's why people do it. But also when your money is in here, it's sort of asset protected, just like a 401k fund. So a lot of my investors, what they do is they'll create a policy and fund it with 100, some even $250,000 a year for 5 to 6 years, which sounds like a lot. But what they're doing is they're funding it, and then they're taking it right back out to invest it. So their money is continually working in there. And a real rudimentary way of thinking about this is it's kind of like a house, right? House, if you pay down your mortgage, you can get it back out via HELOC, even though it's very inefficient, right? The banks are going to screw around with your evaluations. But with this infinite banking policy, it's a lot more efficient. You put the money in there, and then you can withdraw it right back out. And when one of these deals cashes out, you just load it right back into your infinite banking policy, pay back your loans. And while it's in there, it's growing tax-free, usually like 4 or 5%. And then the other trick is when you borrow money out, I mean, you should be calling it a business expense, so you're able to write it off. But yeah, I mean, we have like an e-course on our website that kind of teach people about it. It took me a couple of years to really wrap my head around it, but like a lot of this type of stuff, it's very easy, except you got to get around the right people doing it too, so it becomes kind of second nature. People teaching each other within a community, that's kind of what it's all about.
Yeah,
kind of reversing the dogma that our parents taught us, where you're told to invest in a 401k, Roth IRA, put money to retirement, buy a house, pay down your mortgage, all the things that they work for lower net worth people who aren't good with their money. But if you're a good saver, maybe invest in real estate, like it's a different paradigm.
Yeah. I've figured out that a lot of that, sort of traditional retirement account path is really just structured to help people that essentially don't want to or don't have the capacity to figure out what the better options are to do. And so they have something, right? Like if you do nothing else, it's a good idea to invest in a 401k. Like if that's the only thing you're doing for retirement, then it's better than nothing, but it's not the best thing that you can do. It's just some of the other stuff takes a little more education and research.
Right. But the government needs to make these things, because 99% of people in this country and maybe this world are really bad with their money. They spend more money than they can make, and they can't keep their grubby hands off their money for buying jet skis or whatever.
Right. Yeah.
Which is why, like, for those people, buying a house to live in is a good idea, because it's a forced piggy bank. Where people like us and listening to this podcast, I mean, we're a little bit different. We're more disciplined. Whether some of us use the envelope system or not, I always joke, tease those people. But if you're good with your money, it's better to get on the offense, not buy a house to live in, invest, grow your net worth that way, and then you buy the vices of life with cash flow.
Yeah, exactly. I've heard people kind of use that strategy is if you want something, what you need to do is buy the asset that pays for it, right? Find that cash flowing asset that's going to pay for your new car payment or whatever it is. That's how you really kind of handle those things. And it takes a lot of discipline, because it's not going to happen quickly. Like, unless you got some large inheritance or won the lottery and you're able to like dump that all into investments, it's going to take you a little while to get to that point. So it means, several years of sacrifice and waiting on some of those other things that you might want, so that in the end, it's kind of easy to get the things that you want. Ultimately it's that sort of get rich slow type of philosophy with real estate. I think I think this is all great information. Maybe what I'll do now, Lane, is we'll just switch gears. I'll kind of get to the part where I ask you questions, just so I don't keep you talking all night long. I feel like there's so much stuff we could dive into. But I'll ask you the questions I ask every guest, and we'll kind of expand on them. But the first one is based on the name of the show being Know Your Why. And so what's your why? What drives you, kind of what pushes you towards this level of success?
I don't know, dude. I'm just trying to figure it out. I go to a life coach and I'm going through like my midlife crisis now. Yeah, I don't know. I'm just gonna keep doing deals and investing in stuff that cash flow and just mindlessly do what I've been doing that got me here. But I ask myself the question all the time, and I think that maybe that's why I do like the podcast and website, to kind of dispel the nonsense out there. I see myself as a little Robin Hood, teaching the right thing and kind of stealing from the rich, which I see as the big institutional Wall Street companies and the REITs, right? That's the problem with that stuff, is they just get kind of rob people blind with all the hidden fees and carried interest, and the hardworking middle class people are the ones paying all the taxes and the fees, and they get screwed over. So that's kind of what's been driving me. But my life coach tells me I need to lighten up and stop stop fighting that fight and find some other hobbies, I guess.
I mean,
So,
I think it's a very valid fight. I think there is a lot wrong with the way that things are structured, right? It's like one of my biggest pet peeves is the whole accredited investor thing, right? Because it's like rich people already know how to be rich. They already know what to do. They're already there. So the people that are accredited already have the ability to kind of continue and grow that wealth. But when you block unaccredited investors from a safe, like excellent investment vehicle like real estate, it's very frustrating to me that's not, it makes it harder to sort of teach people maybe the better way to do it. Whereas anybody can put their money in the stock market and lose all their money in the stock market. Like there's no rule that stops you from doing that. You just need a Robinhood account. Like it's not hard to do.
yeah, I mean, I think the same thing, but then I saw like, all these crypto altcoins, right? They're essentially like you should be able to go through like a 50-page, 100-page PPM to get into one of those things. But these non-accredited investors who just do whatever.
Right.
There's no fundamentals and no investment philosophy. They just do whatever they can, and they're going to lose their money at some point doing this stupid stuff. So I get why the government doesn't trust the average citizen, so I don't know. I see it both ways.
Yeah. It's not, yeah. The fact that they don't trust people to do the right thing with their money makes sense, because it's been shown time and time again that a lot of people don't do the right thing with their money. But the bottom line is, like, they're letting people do the wrong thing with their money, with crypto, with stock market. I mean, I don't know if crypto is a good thing to invest in or not. Like, I'm not actually trying to make stock advice. I'm just saying there are ways that you can blow your money very easily. You don't have to be an accredited investor to go to Vegas. Like, it's not, you could lose all your money in one day in Vegas. Like it just doesn't. So it doesn't make sense to me that then it's so very highly regulated to get people into real, like you can't get some of your friends and family into a real estate deal in a lot of situations. So it's just kind of a weird, I don't know. It's a weird dichotomy.
Yeah, I don't know. Yeah, I think the same thing, man. It's frustrating, isn't it?
Yeah. Anyway, we'll get off the soapbox, but
yeah, we'll be on social media writing long posts about what things we can't change and complaining
exactly,
about
yeah.
other people's qualms.
Writing long posts that the government won't care about at all.
Yeah, but we'll continue to beat our drum because somebody will care.
Yeah, hopefully
Facebook,
we reach one or two people.
Yeah, and then Facebook will guide it towards people who care.
Right, exactly. All right, second question. Tell listeners something about yourself that maybe isn't common knowledge. What do we, a special skill or a hobby or something that maybe not everybody knows about you?
I like to do some CrossFit. I don't surf. I didn't like the beach growing up. I was a geek. That's why I became an engineer.
Don't surf and you live on Hawaii.
Yeah, I became an engineer so I could just like have the highest paid salary without going to grad school. I always just do the easiest thing. So I found this passive real estate investing thing.
It's working out well for you. So I would stick with that philosophy. No, that's cool. When people hear this and they want to reach out to you, what's the best way to get a hold of you? And we'll put whatever you want in the show notes.
They can check out simplepassivecashflow.com, and then if they listen to podcasts, Simple Passive Cash Flow, or just Google me, Lane Kawaoka. I think I'm the only one there.
Good. Final question, Lane. What piece of advice would you give to people that are maybe getting started in real estate and kind of trying to get their foot in the door? How would you advise them?
Depends where they are net worth, and what I call the journey, right? Like if you're not an accredited investor and you're under $250,000 net worth and you make less than 6 figures, dude, it's gonna be tough. Go buy some rental properties, get comfortable, because it's gonna take you a while to get up to $500,000 net worth. But if you're making even low 6 figures, I mean, maybe you could buy a rental property to just get the hang of it. But if not, find some people around you doing this type of stuff, and invest with people like, and trust, and keep calm, cash flow on.
Yeah, totally. Awesome. Well, thank you so much. I appreciate having you on the show. I really like kind of digging in on all those topics that it seems we both have agree that maybe things aren't always structured the right way, but
yeah, we're becoming like
on.
old grumpy men. I think we start to talk about things you can't change.
Exactly. Yeah, exactly. Get off my lawn. It's just that.
Yeah.
It's just that. Yeah, that kind of mentality of like.
Yeah.
You want to fix the world, but
like I said, I'm going through my half midlife crisis.
Yeah,
changing things I can't change.
Exactly. But thank you again. Thank you for your time. It was awesome.
Okay, go Jason. Thanks, man.
All right, take it easy.
I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you.